Hi, everyone. It's Rick Bensignor, and welcome to this week's In the Know Trader Show. This week, we're going to take a look in our half-hour show. We're going to look at the S&P macro sector relative movement and the S&P itself that we do every week. But up on today's agenda, we're going to spend some time looking at the gold market and specifically what happened to its bull market. Virtually everybody's been bullish gold since it broke out over the, I guess it was probably late spring. And it's obviously pulled back quite a bit. And we're going to get a little more specific into it. I want to also do a little bit of a teaching segment on something called a recycle count, which showed up in the S&P chart, which is part of the DeMark model that we look at. And I want to show you where it is on the chart and why it happens, because it happens rarely, but it's one of the few times that the signal that's on your chart can actually disappear. And then we will conclude with the argument of growth versus value. The street is certainly saying it's value's time. Many top strategists on the street are saying that after years of underperformance, and we saw the big shift in September where value hugely outperformed growth for the first time in a long time. So we'll take a look at that and see if our charts concur with what the street is saying. So pardon the little sniffles. I woke up this morning with them out of the clear blue. And so you're hearing a little bit of a nasal Rick today, but that's how it goes. So on the right-hand side, the S&P over year to date through last night's close. And on the left side, the chart is through last Tuesday's close. So we can see the difference that's occurred over the week. There are 4 sectors that have moved 1% or more in the past week. Red dots mean they've lost 1% or more in relative performance to the S&P. So we see materials down almost 5%. Last week, they were only down 3.5%. So not a good week. And one of the ways that certainly shows up is one of the pieces of the material sector are the metals, and metals have certainly been struggling. Consumer staples also down 1.84% versus the S&P. Last week they were only down 81 basis points, so that picked up just about 1% of underperformance. Also not a big surprise considering the market has pushed to new highs, and it's not that long ago that staples were outperforming, and they are now underperforming and getting worse. The best gainer of the week by far has been healthcare. It was down almost 11% last week versus the S&P. Now it is down less than 9%. So that picked up over 200 basis points of outperformance. And then the last one is real estate, which was up 3% last week. It is now down. It is now up 58 basis points. So that lost a couple of full percentage points over the last week and getting closer to potentially even underperforming. And for the bulk of the year, real estate had been the second best performing name, at times up 10% or more versus the S&P. So you have seen a dramatic shift in that sector. And to me, so this is kind of interesting too, because when you look at real estate, a lot of that sector has to do with generating income, and of course, therefore, interest rates are a big factor in the real estate market. And the 10 years kind of sitting right near 1.75%, off of the lows of 1.45%, but also off of the highs of 1.96% that we saw recently. So it's kind of mid-range and kind of staying there, and yet we've seen a dramatic shift in the investment holdings in the real estate sector, with them really just barely outperforming the S&P now. So it's much more of a market neutral to the S&P, and the fact that it gave up 1,000 basis points of outperformance is an indication that institutional investors feel like interest rates are not going lower. At least that's how I look at it, because of that dramatic a shift coming in the investment side of the real estate names, yet interest rates themselves have, as I said, moved up, but haven't moved up so much. Yet there's clearly a shift here in psychology of a sector that's moved 1,000 basis points in a few months. So that to me is of interest. As far as getting in touch with me, it's rick at inthenotrader.com. And of course, our website, same thing, www.inthenotrader.com. I will mention that in the next speaking engagement I have, as far as a conference that I know of, is in February. It will be on, I think it is Saturday, if I'm right, that it's a Saturday, February 7th. It's either the 7th or the 8th, whatever that Saturday is, in Orlando at the Money Show. And so any of you who are in Florida and you want to come and see me speak, please go and sign up for the show. So let's now take a look and shift to, not that, here we go, to our charts. And let's start off with the S&P, just in a general sense. And what we had said a week ago is that we had seen a sequential 13 count. Again, that's a Tom DeMark model that looks for exhaustion of trend. When the numbers show up on top of price bars and you get to a 13 count, it's often an indication of exhaustion of trend, or at least a high risk time to be a buyer in an uptrend. So we've got two of these signals that have shown up over the last several months. And what we're seeing is unrelated to that 13 count. I've got two other price projections that kind of brought us right to the 31.22 to 31.36 level. We're right in there now. The stop out level on the 13 is at 31.42. So we're kind of right in the place that if we can again, I guess I'll use the word push higher, and get another decent thrust, then we've got plenty of room on the upside again before we get targets, or at least significant targets that are almost 5% higher at in the 3,300 neighborhood. Personally, I am not buying anything right here, right now because of this, despite the fact that the market's up, and today again on all-time highs. The S&P, as I speak, is up 5.25 points. Got as high as 3141.65. It's about 2 or 3 points beneath there now, so just off the highs. But again, I'd be more comfortable waiting for, even if it's a mild pullback, rather than chasing after here. So that's the way I look at the S&P right now. Places to consider getting long would be near 3,085, and on a deeper decline, 3,030 or so. Those would be the two places that, if we got some correction between now and year's end, that is those are the two entry levels that I would have as of right now. Once we're on this chart, I'm going to jump ahead of getting to gold, which we'll spend a little bit of time on. And I want you to focus on, in the chart, the rectangle here that I've got highlighted in pink, and you'll see there's a letter R there. That R used to be a 13, just like this 13 here, just like this 13 here. But what happened is, after we got to this 13 count, the market kept moving higher, such that every single day we kept closing above the close from 4 bars prior. And if you go to a, let me think, I think it's 23 bars. If 23 bars gets you 23 bars in a row of closes above the close 4 bars prior, the 13 signal will actually come down. And it's probably one of the few complaints that people would have about a DeMark model, is that particular thing that you could have actually seen a 13 on your screen, and then at some time afterwards, and let's say you played it, and then all of a sudden it just disappears. And what happens is, the market is so strong, the model is actually saying, even though it's past the fact, disregard the 13. So I can understand people having complaints about it. Again, it doesn't happen that often that after you get a 13, it actually comes off your screen. But in this particular case, it did. And therefore, what used to be a 13 gets substituted with the letter R standing for a recycle count, and therefore the 13 comes down. And this 13 stays valid, and it's already pulled back from the 13 count, so there was no, there's no way that this can get recycled. But in the case of the one here, we never closed less than the close from 4 days prior after we got to 13, and that's what kept this count going. And eventually it got high enough to say, you know what, this is just a wrong indication for looking for exhaustion of trend. So one of the people who understand this model, who wrote me about it and said, can you please explain the R on the chart and what it means? Well, that is it. It is a recycle. And again, you don't see a lot of these happen. And it is a valid complaint, because at the time it was there and you could have easily played, you know, from what that signal indicated. However, this is the textbook definition, and this is how DeMark looks at it. So it is one of those few times that a signal appears and actually changes. Otherwise, everything else on the chart won't. And you know, I'll tell you that any 9 count you ever see, a setup 9, whether it's on the downside or the upside. So in this case, this was 9 consecutive days that the close was less than the close from 4 bars prior. In this case here, in early June, 9 consecutive days, close greater than the close from 4 days prior. Those 9 counts will never disappear on the chart. We can look back 20 years of the S&P, and every single one of them that was ever made will still always be there. So setup 9 counts never disappear. What do occasionally, and when I say occasionally, I would say it's not 5% of sequential counts that show up, but occasionally you get so much strength or so much weakness in the market that the signal that looks for exhaustion of trend is just erased after the fact. And that's the explanation that I wanted to show you and talk about. Let's move on now to the gold market. And there's 2 things I want to look at here. Let me see. Besides the chart itself, I think I have it. Let's see, is it here? No. So perhaps it is here. Yes. Okay. Follow my cursor right here in the middle of the chart where it says gold. This is the CFTC's report, the Commodity Futures Trading Commission's report that comes out weekly, and another report will actually come out today. And by the time this gets broadcast, the new report will have been released. But this is as of November 19th. A week ago, the positioning of those people who have contracts open or who make up open interest in the futures market for gold. Now, it gets broken down into several categories: producers, merchants, processors, and users, and whether or not they're long or short, and how many. So this says there are roughly 39,000 longs, but 166,000 shorts. These are what are called the true hedgers, and in the industry considered smart money. Why smart money? Because if you're in the gold business, either as a miner, as a processor, as an end user, you're going to know more about the gold market than the average person who's just looking at a chart and speculating. So typically, this left-hand column here, producers, merchants, processors, users, are considered smart money. We go across the screen to managed money. That's the side of the industry that are commodity trading advisors and the big funds that, if they want exposure in gold and buy futures contracts, these are speculators, but they're not individual speculators. These are the big funds that come in and sometimes buy or sell thousands of contracts at a time. So that's managed money. And what do we see with managed money? There are almost 222,000 contracts long versus only 26,500 contracts short. So by a ratio of over, what do we have here? 8 to 1, is it? Yeah, over 8 to 1. You have speculators long gold for every contract they're short. That is a tremendous one-sided bet that we're seeing. The other reportables here on the right-hand side are smaller speculators, people like you and me. If we're long a couple of contracts of gold or short a couple of contracts, we're not big enough to be considered managed money. So we're individuals in very small funds. Those are the other reportables. And in this case, take a look, 115,500 contracts on the long side, barely 25,000 contracts short. So there is a huge, combine the small speculators, the 115,000 contracts, with the almost 222, and you have, what do we have there at 15? 300 and, let's say, 36,000 contracts long versus only 50,000 contracts short. That's over 7 to 1 that speculators are long gold, and the smart money is well short gold. So the producers, the merchants, etc., are on the other side of those futures contracts. They are net short versus all these longs. That's the first thing of importance to realize as we now go and take a look. And by the way, people look at this report every week that it comes out, and they look at typically the shift in what are speculators doing, especially if they keep adding to longs as they did a week ago. Notice that they added 12,000 contracts long, but they only reduced shorts by, and they reduced shorts by 7,400. That's a net differential of about 19,000 bullish contracts, right? Less shorts plus more longs. That's all bullish. So you've got 19, almost 20,000 contracts added to the bullish side from a psychology point of view. So gold's been coming off, which means even as the market has come off, speculators continue to buy gold. So now let's take a look at the gold chart. And we're going to kind of go through this piecemeal, and I'm going to add and take away different indicators as we go through it to get a sense of what's going on and what the different indicators say. So let's start off here. This is a basic rolling futures contract. So the December futures contract is currently the front month. Very shortly, February, gold will be the primarily traded gold contract. And it's very clear to see. Hold on. It's very clear to see where all the major highs had been in gold for years. So there's not one breakout point that happened this summer, but somewhere between 1350 and 1375, 1380 or so, gold finally broke out after 6 years of peaking between 1350 and 1400 every time it rallied. The bottom in gold was at 1050. So that's a $325 range that it had from low to high over those 6-year period. And the bulk traded between 1150 and 1375. But let's take the max here, about 1050 to 1375. That's $325. Add $325 to the 1375-ish breakout point. That gets you $1,700 gold. So somewhere up where that new purple here, let's just change colors. Where that green line is over time is where this move measures to. But notice that gold stopped just north of 1551 week. The highest weekly close gold had for any front month contract was 1526. And I'll show you that from here to here, and let's again make these different colors. So where the pink colored lines are was the target I had for my institutional clients to get out of the gold longs that we got into earlier this year, just south of 1300. We got long at 1295. We watched it go $20 against us, and then we had the huge move up, and we got into this zone. And I got out towards the lower side of the zone because I was content making just about $200. We got out at 1491 and a half, so just shy of $200 that we made. And when I got out, and I made it a very public call. I was on TV doing so. I was some of the Real Vision videos. One of them I said, you know, we're exiting gold. I got a tremendous amount of flack from people saying you're crazy. Gold's going to 2,000, 3,000, 5,000. You know, you're out of your mind to get out of gold. Well, it's now several months later. We missed $30 on a Friday closing basis. We missed as much as $30, $35, which is a few percent, but not much more than that, right? $1,500 gold. So maybe we got out 2% or so from the highest Friday close of the whole move. And this is where we are now. So now let's switch it back to a daily chart. So here's, and I'll maximize this. So here's the daily chart. And notice even today's low, we are in a very precarious place for gold. This trend line that exists from the gap up that we saw in June, as contracts rolled, ended up being the trend line of real significance right now. So right now we're on the verge of a breakdown. What else do we have besides that that's telling us what gold looks like? Well, let's take a, let's find, where are you? MACD. MACD's been weak since actually pretty much early September, right around coordinating with the high of the move. The lines pulled apart significantly, so there's some real downside momentum, and it's been selling off as the market has sold off. So that's kind of been in alignment. And we don't have, the only buy signal you had was down here, so that was just about here. So it was good for a week max before the bigger downtrend came into place from that high. Let's take a look at what the cloud chart says. Price is underneath the shaded portion. The shaded portion is the cloud. Price is underneath the cloud. The lagging line is underneath its cloud. That is bearish. There is nothing bullish in the cloud chart in this time frame, in the daily time frame, to be long gold. Let's see what else we have. Let's look at Bollinger Bands, and let's take the cloud off just because too many lines start making things get confusing. So Bollinger Bands narrowed. They then widened out on this down move. They remain fairly wide. So you still have a sense of volatility, higher volatility than we had a month ago. And there's still downward pressure as we went from the top band to the bottom band, pretty much to the middle. And now we're somewhere in between the middle and the bottom. That's not bullish, at least at this point. Now, what else do we have? Let's take the bands off. These very dark maroon dotted line or dashed lines here are bearish propulsion levels. If you properly close underneath them, it would say that you would go to the red triangle. Getting beneath there could measure all the way down to these orange triangles. So right now, you have a combination of a trend line holding and getting a bounce above this bearish propulsion level. That's good for bulls in the sense that it's holding support for now. Here's a potential problem even as early as, what day is today? Tuesday, so as early as tomorrow and Thursday. Today is an up close, or at least let's assume today closes higher. At least, gold has rebounded from some early losses, and it's up about $5 on the day right now. If gold closes higher today and then closes beneath 1456.85 tomorrow, and Thursday morning gaps lower and takes out tomorrow's low, these horizontal lines turn into triangles. It says that is actually a qualified and confirmed signal to the downside, and it would minimally target 1434.5. It doesn't mean it's going to do that, but we could get a fresh sell signal in gold as early as Thursday morning's open, especially if it opens lower than if tomorrow is down and we open lower on Thursday morning and we trade lower than Wednesday's low, we've got a fresh sell signal. Now, when I combine what this looks like with the open interest and the commitment of traders report, so let's take a look at two now. What's open interest doing? Open interest grew as the market came off in the early part of the month, and now over the last several days is falling. So I'm an old commodities guy. This is where I first got into the business, and for 12 years I traded in the commodities picks. What's it mean when open interest is falling and you have price coming off? It means that shorts are getting out. Who's short right now? The hedgers are short, so they're taking off some of their shorts as people who are long, the speculators, are unwinding their longs. Because both are closing out their positions, open interest is falling down. So you are finding some of those shorts buying against some people who are long, who can't take the pain anymore of being long and are starting to sell out. So this is looking at open interest to give us a clue that the buying and the selling being done now are both to close out positions. So some of the shorts are saying, okay, I don't think the market's going much lower. And some of the longs saying, I don't think we're going higher, or I've lost too much money and I need to get out. So in conclusion here, I think that until we see a much more significant decline in the open interest on the long side from speculators, instead of being 7-1 bullish, if we can get it down to maybe 4-1 or 3-1, then you know that you have a more balanced market and the chance for gold to rally. But for that to happen, you probably need a shakeout to the downside still. You need to liquidate all those contracts that the speculators have because they're just way too one-sided in the market. So that's my take on gold. So I am not buying gold, even though right here, right now, we're finding some support. The last thing I want to take a look at, and we're away from gold now, is switching to growth versus value. And this is a daily chart going back a couple of years. And I've chosen the IVW, which is the S&P 500 growth ETF, versus IVE, the S&P 500 value ETF. I've highlighted all the 13s on the chart. Again, when they come above price action, it's looking for price exhaustion. So this one here back in 2017, a little early. This one pretty good. Went down for almost a month, made a new high, and then sold off rather strongly. There's a 13 in here that was good for a few months. There's a 13 in here that basically said this move is going sideways. Eventually, it pulled out to the upside, big move down. There's a 13 here. But more importantly is recently, for the first time, we're seeing a daily 13 buy in favor of growth. Now, the street is telling you to disregard, to play that value is going to outperform. And it did, certainly, since it peaked in August. But I have enough signals here right now saying growth is the way to go. Now, do I think this is just going to turn around and plow through all these months from back May, June, July, and August? Probably not. But until we get more towards resistance, I'm not putting this trade on for value to outperform growth, because when this ratio moves higher, it means growth is outperforming. And given that 13 signal to say exhaustion of downtrend of value outperforming, right now I'm in the camp that growth outperforms until we get higher up, maybe near resistance up here. Then I'd think about putting the trade on. So that's it for this week. We looked at the S&P sectors, a deep dive into gold, and now growth versus value. Hope that was helpful. That's it for until next week. I'm Rick Bensignor, and this is In the Know Trader.